Rohr here with an early global view on Friday, November 11th, 2014. It's currently 6 a.m. U.S. Central Time. We're coming to you a bit early, so this can be posted up prior to the U.S. employment report just a bit later this morning. And there are quite a few macro factors that are most telling, especially the influence of the more aggressive accommodation signaled by the ECB yesterday. So what do all those various macro factors, especially the ECB QE commitment, mean to the markets? Well, we had been noting earlier this week on the S&P 500, and of course this is our short-term view, hourly on the left, 30-minute on the right, with indicators below as usual, that it had been having trouble escaping the old high. We still left this old Fibonacci here, 2012.5 on the contract and 2013.5 lead contract futures from just before September expired back on September 19th. And it had been getting up somewhat above that area, playing around with it, as we saw from right away on Monday this week, but not really seeming to hit escape velocity until it went through what we call a trickle up yesterday. So even after Mario Draghi spoke, for the first hour or so yesterday, the market was still stuck not too much better than 2013, but by later on in the day, very possibly in anticipation of another positive U.S. employment report today, the market pushed up. Now, this is important for a couple of reasons. One is that we had the down break that was attempted as the market churned sideways into the election on Tuesday in the U.S. midterms, and once the results came out, not surprisingly, the more consolidated control of Congress by the Republicans was able to have it gap higher, and that reinforces the support back somewhat below 2013, right around 2007 to the previous failed upside acceleration in about the 2005 area, and you could see how the market just could never even quite get back down there. And also the steady push up yesterday put the hourly MACD back out above its upper runaway band, which unless the bears were going to get success by later on yesterday, it was going to push up. So the question is, well, where's this going? Well, the next oscillator resistance is this week at 130 over. The 41-week average would point toward 2045. The topping line's at 2055. But those each move up approximately $5 in the next week. So you'd be looking out in the next week at 2050 to 2060 as the likely next resistance if the market should continue higher, which seems to be more likely than not at present. That pretty much does it for the short-term view of the S&P 500.